The Bank of Botswana held its annual monetary policy statement intended to review the country's past year's economic developments, evaluate the main determinants of price changes and the extent to which inflation deviated from the bank's medium-term inflation objective range of 3 to 6%. For an update, we're joined by Geraint Tudor Jones, a Sub-Saharan Africa Analyst at Business Monitor International, and he joins us from London. Thanks, Geraint, very much for your time, Geraint. If I can perhaps just ask you broadly, are there any sort of headwinds and any red flags for you in terms of Botswana's monetary policy statement?
Okay, hi. So the statement sort of highlights a number of the key issues and challenges facing the economy, but was broadly consistent with what the bank and the authorities have been saying in recent quarters. For the bank, the main challenge for us remains controlling price stability on the one hand amid persistent short-term price pressures, and on the other, facilitating economic growth amid restrained government spending and weak private consumption. In terms of inflationary pressures, we see these easing gradually in 2013, but nonetheless remaining elevated and outside the bank's target range for the remainder of 2013. A number of short-term pressures include food price inflation, which has been persistent. Fuel prices should ease, although there's also the risk of unanticipated government levies, such as the one seen on alcohol and petrol prices in late 2012. So all these short-term price pressures pose a risk, even though the underlying pressures remain one of easing through 2013.
Yeah, but what can the bank do in this instance? Because we do know that for the first two that you mentioned, food price inflation as well as fuel price inflation, those two are largely outside its control, given the dependence of the country on South Africa and the movements of the rand exchange rate against the dollar.
Well, that's right. I mean, and from the messages from the statement today and the messages from the bank in recent quarters is that they're going to likely maintain a cautious stance. We don't see the bank adjusting rates for the remainder of 2013. We see them being kept on hold at 9.5%, where they were recently kept at the last Monetary Policy Committee meeting. Potentially we see room for adjustments in 2014, but given that inflation will remain outside the bank's target range, there's little the bank can do in terms of a monetary policy in this regard to control inflation, although we think the assumption being that the price pressures will ease should negate any action on that.
Yeah, so with the price pressures likely to keep inflation outside the bank's target range, 3.6% as you mentioned, what risk then for holding Botswana assets, particularly in this environment where you're expecting them to probably ease while at the same time inflation remains a threat and outside of its range?
Sorry, I didn't catch that. Could you just repeat the question?
Okay, so I'm asking if there's a risk of holding Botswana assets in this environment where you are saying inflation is likely to remain outside of the bank's range. At the same time, though, they might come under pressure later on in 2014 to further ease interest rates.
Well, we see these inflationary pressures gradually easing. I mean, the bank also sees over the medium term inflation pressures easing, and we also see this happening as domestic demand is likely to remain weak, and government spending is also going to remain subdued. So, over the course of 2013, we think the short-term pressures will ease, and likely these pressures on the bank will also ease come 2014.
So would you recommend investors continue holding Botswana assets given the outlook that you've just given us now? What would be your recommendation?
Well, at this stage, it's very difficult to say. I mean, a lot of these short-term price pressures can be quite hard to predict. So it would really depend on the situation going into 2014. At the moment, we'd say rates on hold until further notice, and the bank's likely to maintain a sort of a cautious stance, given the balance of risks as they are.
What can the bank do you think, in these circumstances? Is it a question of just keeping steady or having to try and think of new ways of tackling what in many cases is just a very uncertain policy environment, and also one which is perhaps has not been as evolved and developed in the traditional sense?
Well, I mean, that's part of the problem, really. The bank is relatively limited in what it can do to control price pressures which are out of its control for a country which is dependent on imported goods for food and fuel, which account for a large part of the consumer price inflation basket. There's relatively little it can do with that regard. The currency has also been weakening alongside the weakening in the rand that we've seen in recent months. That's also likely to put additional pressure on inflation. The government's trying to tackle the root causes of inflation in terms of broadening the manufacturing base, diversifying the economy. Again, this is going to take a while. We don't expect these sort of pressures these developments to be felt over the medium term. So really, the government is slightly hamstrung by what it can do to combat inflation at the moment.